The latest economic data is keeping some inflation fears alive. PPI, the wholesale price measure, was up 0.2 in August, about in line. But if you exclude food and energy, the core was up 0.3, very similar to CPI yesterday. It was slightly hotter than estimates. And on the jobs front, the number of Americans filing for unemployment benefits looked okay again last week at a relative historically low of about 230,000. A bit above forecast. We're not seeing widespread layoffs yet, though. Any signs that the labor market is broadly cooling, but we're starting to get a little bit of that in the payrolls, at least. And my next guest says you could make an argument for the Fed to start with a half-point cut, although a quarter point is more likely. For more, I'm joined by former Cleveland Fed President Loretta Mester. She's now an adjunct professor of finance at the Wharton School at the University of Pennsylvania and a CNBC contributor. Welcome to you.
Thank you very much.
So now you can talk freely. You can tell us what you really think, that they should go 75 or full points. What really do you sort of make of the situation we're in right now economically?
Yeah, I mean, we know that inflation has come down quite a bit. The most recent data, was not according to expectations, but it didn't take away from the fact that inflation has moved down over time. And the committee has said it's become more confident that it's on that path back to 2%. It's not there yet. More work to do, but on its path. And the labor market obviously has moderated. You know, we've seen a slowing in terms of employment growth, but it isn't weak, right? The labor market's still solid, right? It's just moving down. So the real question is, what do you do with policy at this point? Mm-hmm. And, you know, they've said, and I think I've never seen Chair Powell be as explicit as he was at Jackson Hole, that we're going to enter this new phase of bringing the funds rate down over time.
So you thought that speech was pretty significant?
I thought that speech was very articulate and more direct than you might have expected a chair to be at that point. So it was very clear that, okay, they're going to enter this cycle. And then the question turned out to be, do you do 25 or 50 to start with?
What you thought the clarity was basically around the rate cutting cycle is starting. So when I was just thinking back to Jackson Hole a couple of years ago when his clarity was really all about inflation. We're tackling it. This is front and center. The new phase that we're entering for you is a rate-cutting phase, a focus on the labor market. What exactly is it?
Yeah, well, there's two things. One, it's a rate-cutting phase, but remember, it's a rate-cutting phase from very elevated Fed funds rate. So I think of it as being reducing the restrictiveness of monetary policy, not going immediately to a neutral stance. But they're going to be informed by what's happening on the labor side of the economy now, as well as the inflation side. When we started raising rates, right, we had to only focus on the inflation side because inflation was so elevated and labor markets were very tight.
So tight. I mean, what did they used to call the Great Resignation? When have we ever lived through a period where workers were calling the shots entirely?
No, right. And so at that point, it made perfect sense to put all the focus on the inflation part. What's happened over time, and the Fed's been very clear about saying this, is that those risks and the two parts of the mandate are coming into better balance. And so now it's very, very important that they do start really focusing on the labor side of the economy as inflation has come down. They're not done yet. Inflation's not back to 2% yet, but significant progress has been made. And over time, I think it is on a path to 2%. Now it's about, is the labor market continuing to moderate or is the labor market weakening?
Sure.
And that's kind of where the focus is going to be. And that's why I think the Fed will be starting this new phase of bringing the funds rate down. 25 versus 50. I mean, I could make a case for 50 if I wanted to, but I think it's going to be hard to communicate that kind of case given where the markets are. But also, more importantly, is do you signal as a Fed policymaker, if you start with 50, that one, right, maybe the economy is worse than the average person thinks,
right.
Or two, you believe you're behind the curve, and maybe that builds in expectations for even more quickly rate cuts than are already in the market. And so that's such a hard case to communicate, and there's no reason to do it, right? So stay away from the complication and signal we're entering a new phase.
Right.
It's not a one and done, right? There's going to be a path here, and we're going to be very attuned to not only where we think the economy is going, but also the risk around that forecast.